For most of crypto's history, quantum computing has been treated as a future problem. Interesting, theoretical, but safely distant. Something for researchers, something for white papers, not something markets needed to price in. That mindset is starting to change. Across the quantum computing landscape, roadmaps from multiple independent actors are beginning to converge. Different companies, different research institutions, different technical approaches. Yet the timelines increasingly point to a similar conclusion. Breaking elliptic curve cryptography, the security foundation of Bitcoin, Ethereum, and most blockchains, could become realistically feasible around the early 2030s. Not certain, not guaranteed, but no longer unthinkable. And that shift from impossible to plausible is what matters. Because financial systems do not wait for certainty. They move on risk perception. One important reason these timelines are compressing is algorithmic progress. Quantum computers are still noisy. They are still fragile. They still struggle with error correction. But hardware is only one side of the equation. The other side is software, algorithms. And here, AI-driven optimization is accelerating progress in ways that weren't fully anticipated a decade ago. Better algorithms mean fewer qubits are required. They mean less error tolerance is needed. They reduce the hardware threshold for practical attacks. That doesn't mean quantum computers will suddenly break crypto tomorrow, but it does mean the margin of safety is shrinking, and markets pay attention when margins shrink. Now, to understand why this matters so much, we need to look at how crypto has changed. Crypto used to be relatively self-contained. When prices fell, the damage stayed mostly inside crypto. That is no longer true. Today, stablecoins are the backbone of the entire on-chain ecosystem. They are the primary trading pair for Bitcoin. They are the settlement layer for exchanges. They are the base asset for DeFi lending, liquidity pools, and structured products. And most importantly, they are how institutional capital accesses crypto. Institutions don't move capital the way retail does. They think in terms of risk-adjusted returns, tail risks, and fiduciary responsibility. If you're managing hundreds of millions or billions of dollars, you don't ask, is this exciting? You ask, what is the worst-case scenario? Quantum risk is a textbook tail risk, low probability, extremely high impact. From an institutional perspective, the math is uncomfortable. Earning an extra 2, 3, or 4% yield on-chain only makes sense if the probability of catastrophic failure is effectively zero. Once that probability becomes non-zero, even very small, the calculation changes. And here's the key insight. Institutions don't need quantum computers to actually break cryptography before they act. They only need to believe the window is approaching. That belief alone is enough to trigger defensive behavior. Now look at what's happening outside crypto. Traditional financial institutions are not ignoring quantum risk. Major banks, payment networks, and infrastructure providers are already deploying or testing post-quantum cryptography. Browsers are transitioning. Enterprise systems are transitioning. Governments are transitioning. These systems don't have decentralized governance. They don't need years of social consensus. They can upgrade proactively. Crypto doesn't have that luxury. Blockchains must coordinate changes across developers, validators, users, and applications. They must consider backward compatibility, performance trade-offs, and governance disputes. That takes time. So imagine you're an institutional allocator watching this play out. You see credible quantum roadmaps converging around the early 2030s. You see AI accelerating cryptographic research. You see traditional finance moving early. And then you look at blockchains. You see fragmented efforts, underfunded research, long timelines, and no clear system-wide migration path. At that point, you don't need panic. You just reduce exposure. The most obvious first move is simple. You pull stablecoins off-chain. Not forever, Not because crypto is dead, but because uncertainty has entered the system. You park that capital in quantum-safe banking infrastructure until there's clarity. If that behavior happens at scale, the consequences are severe. Liquidity doesn't just leave Bitcoin. It leaves Ethereum, it leaves Solana, it leaves DeFi entirely. This is not a price crash driven by speculation. It's a liquidity contraction driven by risk management. And liquidity is the lifeblood of markets. When it leaves, volatility increases, spreads widen, leverage collapses, and ecosystems shrink. That's why this is not a Bitcoin-only issue. It's a systemic risk to the entire blockchain ecosystem. Now here's where things get interesting. Post-quantum cryptography isn't just a defensive upgrade. It's a competitive advantage. Blockchains that can demonstrate a credible, well-funded, and measurable path toward post-quantum security will likely attract liquidity. In other words, post-quantum readiness may become one of the most important differentiators between networks. Not tomorrow, but sooner than most people expect. And yet, despite the scale of the risk, investment today is minimal. If you assume even a small probability that elliptic curve cryptography could be compromised within the next decade, the rational response would be massive investment in migration. Right now, that isn't happening. The gap between systemic risk and preparation is wide, and gaps like that don't close gently. They close through stress. The takeaway is simple but uncomfortable. Quantum computing doesn't need to arrive to matter. Markets move on belief, institutions move on risk perception, and liquidity always moves first. The question isn't whether blockchains will eventually adapt. The question is whether they will adapt before capital decides not to wait.